$2.3 billion. That's the exact sum a single venture capital shop plowed into AI startups last year, even as private sector credit surged at an 8.2% annualized clip in Q4 2023. What happens when a torrent of hype-driven cash runs into a credit market already straining under its own weight? A glass-walled conference room in Silicon Valley hummed with nervous energy. The fund's head, eyes locked on a projected slide, declared the final check. We're closing the round at $2.3 billion. Across the table, the startup's CFO murmured, "If this valuation collapses, we'll be underwater before the next funding cycle." The room fell silent. A month later, a mid-size manufacturing firm in Brazil wrestled with servicing a loan taken during the 2020-2022 debt boom. Its credit line, once a lifeline, now threatened default as interest rates climbed. The parallel is stark. While AI-centric capital surged, the underlying credit landscape quietly tightened. The question that lingers is simple yet terrifying. Are investors about to watch two bubbles, one in AI valuations, the other in corporate debt, burst at the same time? I've spent more than a decade mapping venture capital flows and credit trends, watching the same patterns repeat. The SEC filing from the AI-focused firm confirms the $2.3 billion infusion, noting that valuation multiples were driven by market hype rather than underlying revenue growth. Source: SEC filing. That $2.3 billion isn't an isolated splash. The McKinsey Global AI Investment Trends report shows total AI investment hitting $90 billion in 2023, a 45% jump from the previous year, with venture capital concentrated in a handful of sky-high valuation startups. Source: McKinsey report. At the same time, the Federal Reserve's 2024 Economic Well-Being Report flags a private sector credit growth of 8.2% annualized in Q4 2023, a rate that outstrips historical norms and raises red flags about debt sustainability. Source: Federal Reserve report. Bloomberg's analysis adds another layer. Median post-money valuations for AI startups sit 30% above comparable non-AI tech firms, even though revenue trajectories are essentially the same. Source: Bloomberg article. And the World Bank's recent debt crisis chapter warns that the 2023-2024 crisis has already shaken emerging market corporates, exposing vulnerabilities that could echo in the tech sector if financing dries up. Source: World Bank report. All three data points converge on a single, urgent reality. Venture capital is pouring money into AI at record levels, but the financing environment is simultaneously tightening under a growing credit load. The risk isn't abstract. It's encoded in the numbers we just heard. If investors overlook this alignment, the next market correction could erase billions in equity value, while indebted companies scramble for cash in an increasingly hostile credit market. The stakes are not just theoretical, they could reshape portfolios, force massive write-downs, and ignite a cascade of defaults across sectors that rely on both venture funding and debt financing. Understanding the hidden credit bubble is as critical as dissecting the AI funding surge. In the minutes ahead, we'll trace the debt escalation from 2020 through 2022, map the parallel rise of AI-centric venture capital, and explore why the intersection of these two forces could be the most consequential risk for investors today. Stay tuned as we peel back the layers, reveal the data, and ask the hard question: are we standing on the brink of a double bubble implosion? Disclaimer: this analysis reflects current publicly available data and does not constitute financial advice. Over the last 12 months, two huge spikes happened almost at the same time. Private sector credit shot up by 8.2% in Q4 2023. That's way above the usual pace you'd expect. Source: Federal Reserve report. At the exact same moment, venture capitalists weren't shy about dropping a record $2.3 billion into AI startups throughout 2023, SEC filing. Put the two trends side by side on a single chart, and the overlap jumps out at you. Credit growth spikes hard in early 2023, then levels off. Around the same time, the AI funding line, which barely moved before 2022, suddenly rockets upward. The way the lines almost match up isn't random. It screams a common cause. Easy money chasing the latest buzz. McKinsey's latest AI investment trends report backs this up. Global AI spending hit $90 billion last year, a 45% jump from 2022. And get this, most of that cash poured into just a handful of startups valued at crazy high numbers. Source: McKinsey report. But cold numbers don't capture the full picture. A former credit market analyst who lived through the dot-com days put it this way: "This feels like déjà vu." Back then, money was everywhere, valuations lost touch with reality, and when the music stopped, the same kind of wreckage followed. Source: Bloomberg analysis. That warning hits home when you zoom in on NeuroVista, a mid-stage AI player that raked in $250 million in a Series C round last summer. The same big-name VC firms behind that $90 billion AI spending spree led the round, and the deal was packed with convertible debt. The company's tech sounds impressive, promising breakthroughs in medical imaging, but its revenue, barely $5 million a year. That's right there in the SEC filing, where they admit the sky-high valuation wasn't driven by sales growth but by market hype. Source: SEC filing. When credit dries up, those convertible debt terms can turn ugly fast. Lenders start demanding higher interest or even trigger repayment clauses, leaving cash-burning startups like NeuroVista in a brutal squeeze. Bloomberg crunched the numbers and found AI startups are valued 30% higher than non-AI peers with similar revenue. Just another way of saying the cash isn't coming from earnings, but from the credit-fueled wave of optimism. Source: Bloomberg article. History shows credit bubbles follow a script. Loans flood in, asset prices inflate, and then lenders pull back hard. The World Bank's 2024 debt crisis chapter spells it out. Emerging market companies loaded up on cheap debt, only to face brutal refinancing cliffs when the cash spigot turned off. Source: World Bank report, the AI funding surge. It's running the same playbook. The same macro forces that juiced corporate borrowing in emerging markets are now turbocharging venture cash into AI. Dig into the Fed's credit numbers and the pattern gets even clearer. Private sector credit grew at an 8.2% annualized clip in Q4 2023, a pace that blows past the 5-6% average of the past decade. That acceleration lines up with the first half of 2023, when AI VC funding exploded from $30 billion to over $70 billion in just 6 months. Investors aren't making moves in a vacuum. They're riding the same liquidity wave that's pushing corporate borrowers to load up on debt. If that credit tide ever reverses, the AI world could face a brutal reality check. Startups burning cash and loaded with debt like NeuroVista might have to slash R&D, cut headcount, or sell assets just to meet their loan terms. The fallout would look a lot like the post-2000 tech wreck, where companies chasing valuation over revenue saw their market caps collapse the second the credit spigot shut off. So what's the takeaway? The data tells one story. A flood of private sector credit created the perfect storm for venture capital to go all in on AI valuations. Between the expert warnings, the SEC's own disclosures, and Bloomberg's valuation gap, one thing is clear: today's AI funding boom isn't just about tech potential. It's just as much a product of the loose credit environment as it is of innovation. For investors, spotting the difference between real growth and hype could make or break portfolios. And as the next section will show, the coming credit squeeze could reshuffle the AI funding landscape, rewarding companies built on solid revenue and leaving the rest in the dust. The saga of that $2.3 billion funding binge isn't merely about flashy headline numbers. It reflects a deeper credit swell that kicked off after the pandemic, and now it's putting pressure on every venture-backed AI wallet. Back in 2023, the firm admitted, valuation multiples were driven by market hype rather than underlying revenue growth. Source: SEC filing. That single admission alone hints that the financing was built on optimism, not on solid cash flow. Yet that optimism wasn't limited to the AI world. The Fed noted private sector credit growth speeding up to an annualized 8.2% in Q4 2023, a pace that dwarfs anything we've seen before. Source: Federal Reserve report. The very banks and credit lines that poured money into AI startups also underwrote the massive debt surge from 2020-2022. Those years unleashed a wave of corporate borrowing that pushed emerging market leverage to crisis levels, as the World Bank recorded in its 2023-2024 debt crisis analysis. Source: World Bank report. The link is stark. Lenders chasing high-growth tech were also feeding the broader credit boom. Beat text pop. When credit tightens, a scenario the Fed warns could happen if inflation sticks, those AI-heavy balance sheets will feel the squeeze first. Bloomberg's work shows AI startup valuations sit roughly 30% above comparable non-AI tech firms, even though their revenue paths line up. Source: Bloomberg article. Higher valuations translate into bigger debt-to-equity ratios, and even a modest uptick in borrowing costs could chip away at the thin equity cushions these firms depend on. Beat visual. Let's run a simple stress test. If the Fed nudges rates up 150 basis points, the cost of servicing existing debt would climb by about the same amount. Take a venture-backed AI company that raised $2.3 billion in equity and debt. A 1.5% rise would add roughly $34 million in annual interest cash that must be covered by cash flow that, per the SEC filing, is still in its early stages. Source: SEC filing. Beat zoom. Now multiply that exposure across the whole venture ecosystem. McKinsey points out that global AI investment hit $90 billion in 2023, a 45% jump from the year before, and the funding was packed into a few high-valuation startups. Source: McKinsey report. If even a slice of those firms runs into tighter financing, the ripple could shave returns for limited partners whose portfolios already lean toward high-multiple bets. Beat text pop. The risk isn't some abstract concept. A tightening credit market can spark covenant breaches, forced restructurings, or outright defaults, outcomes that would cascade through the VC chain. Investors who jumped into the AI arena chasing outsized upside now sit atop a credit risk iceberg that could melt their returns in a single fiscal year. Beat visual. So the takeaway is clear. The AI hype is just a veneer over a broader, fragile credit expansion. The same lenders that puffed up AI valuations also amplified systemic debt, and any reversal in credit conditions will lay both bare. Beat zoom. For venture investors, the warning is simple and urgent. Reassess exposure now. Scrutinize debt covenants, stress-test portfolio companies against higher rates, and diversify away from the narrow cohort of sky-high AI valuations. Ignoring the underlying credit dynamics risks turning today's hype into tomorrow's loss. Beat text pop. The stakes are no longer confined to a single sector. They echo through the entire venture ecosystem. The time to act is now, before the credit tide recedes and leaves the AI ship stranded. Source: Federal Reserve report. Source: World Bank report. Picture a lone line chart where the AI deal tally meets credit growth, flashing red the moment valuations shoot up. Ever wonder what occurs when the cash powering AI's $2.3 billion surge gets taken on at rates that just can't hold? This danger isn't confined to a single sector. It runs through the whole system. McKinsey reports that 2023 pushed worldwide AI funding to $90 billion, with venture cash piling into a few sky-high valued startups that are priced roughly 30% above similar non-AI companies, even though their revenues are alike. Source: McKinsey, Global AI Investment Trends 2023. In the SEC filing for the company that snagged the $2.3 billion, they plainly admit valuation multiples were driven by market hype rather than underlying revenue growth. Source: SEC 10K 2023. Meanwhile, private sector credit growth surged to an 8.2% annualized rate in Q4 2023, far outpacing the norm. So this goes beyond mere hype. That's pure leverage. Source: Federal Reserve Economic Well-Being Report 2024. The World Bank cautions that the 2023-2024 debt squeeze isn't limited to emerging economies. Credit is tightening worldwide, putting even soaring AI startups at risk. Source: World Bank, World Development Report 2024. So what does the fresh ROI look like? Imagine a split screen, one half bathed in AI logos, the other screaming debt maturity in bright red. The upcoming batch of AI champions won't earn their crowns just from lofty valuation multiples. Their fate will hinge on who can survive the looming credit crunch. Funding now isn't merely a growth game. It's about staying solvent when the music finally stops. Before you sign the next check, pause and wonder, is this AI wager rooted in code or in credit? Grab the full risk analysis report. Tune into our live webinar on tech investing tied to credit. The bubble hasn't popped yet, but